So like the things, right, the coverages we're going to dive into today are pretty common though, right? I mean, like everyone sort of like needs, most people need and have these types of things, right?
Yeah. Or if they don't, they really should. If they live somewhere or drive a vehicle.
If they live somewhere, yeah.
Or have assets.
Yes. This is good, right? Protect those things that are so important to you, including your property and other assets.
Yeah, well, you said property, and I had to look this up because I was like, we call it property and casualty insurance, but like, why?
Why?
Because like property is kind of self-explanatory, like it's your stuff, your property, the things you own, or like your real property, your real estate that you're protecting. But what about the casualty side? Like that doesn't seem to fit, right?
Yeah, I mean, I don't like casualty. Yeah, to me, when you say that, I think of like, I don't know, like some sort of war thing, like casualties. You know what I'm saying? Like not
casualties of war. Yeah. So I looked this up. I don't usually do a whole lot of research and prep for our episodes, but I had to look into this one.
Yeah.
So I found the Cornell Law School's Legal Information Institute. They have legal definitions.
Okay.
And the legal definition of casualty starts out like this. Casualty can refer to both an unforeseen accident or disaster, as well as the resulting harm from said accident or disaster. Whether people, places, or things, anything can be considered a casualty of a certain harm. So now it makes sense, right? Like, you cause harm to someone, your insurance steps in and covers you. Or something happens to your property, a casualty of property, your insurance will step in and take care of that if you carry that coverage.
That's brilliant. Yeah, no, that's exactly what that is. And by the way, that Cornell site, I love that place. It has some of the best material for free to access stuff like that, including the entire Internal Revenue Code, which I've frequented on their site.
Well, that makes sense.
In the past. Yeah.
So today we're going to kind of go back to basics on property and casualty insurance. Since we've gone to like the very basics of what property and casualty mean, we're going to step into some different types of P&C, property and casualty insurance, in today's episode of Money and Taxes from BB to XYZ, the show where we break down a single money topic and explain how it could affect those across the generations, from baby boomers to X, Y, and Z. I'm Regina Neenan, certified financial planner and accredited behavioral finance professional.
And I'm Jason Speciner, certified financial planner and enrolled agent. And I think the first place to start with this one would, for me, be just what property and casualty insurance is not, right? And so sort of the more familiar insurances that I'm sure some of our listeners are thinking about, but are not related to this discussion, are things like health insurance, things like life insurance, right?
Yeah.
Annuities, which is market insurance.
Disability insurance.
Disability insurance, exactly, right? As like a form of health insurance, long-term care insurance, right? So there's a handful of insurances that basically protect your life and limb, for essentially, and market in the case of annuities, that are not considered a part of the property and casualty insurance lineup.
Yeah, they don't fall under the umbrella. Get it?
I think so. I see what you did there, but we're going to have to tell our listeners a little more about your wordplay here.
Yeah, well, I actually like to think about property and casualty insurance as an umbrella. It's literally the umbrella policy kind of goes over the top, and then on either side of the umbrella handle, you've got your auto and your home insurance.
I like that, right? Because I mean, those are the two main. Again, like we talked about, if they live somewhere, right? If you live somewhere and you have a vehicle, you're probably going to have those two things, whether or not you own the place you live or not, right?
Yeah. So instead of homeowners insurance, you could have renters insurance under that one side of the umbrella, usually auto on the other. And then the umbrella actually stacks on top of the coverages of those underlying policies.
Now, so what's the purpose of the umbrella? Like, couldn't the homeowners and or auto policy just sort of do the job from a liability standpoint?
Yeah, that's why we didn't really talk about it as one that you really should have. You only need it when your assets reach a certain point where you can no longer get coverage for your liabilities for that amount on your auto or home or renter's policy.
Meaning like when you no longer, like your assets are in excess of, like the assets that would be available to creditors and judgments and all of that are in excess of your limits on those homeowners and autos policy. Yeah. Okay.
Yeah,
That makes
your
sense.
liability limits in particular. So if you
Yeah.
cause damage to another person or another person's item, property, that liability would step in if they, try to sue you for the damage
Yeah.
or harm that you caused.
Right. Because, and that's the important thing here, right? Is there's this sort of intertwining of liability insurance as well as property insurance, right? Like protecting the property involved, your car, your home, your whatever, right? Not necessarily your goof because you did a thing and somebody slipped and fall and hurt themselves, right? That's your liability. But yeah, so there's also the property, or dwelling, I guess, or collision or whatever these other terms are.
Yeah. So, tree limb falls down and damages your roof. Your insurance would step in and help out with that claim if you didn't want to take that on personally.
Yeah. But of course, sometimes then does it even, make sense in some cases, right? Because I know one component, right, that I'm sure you can tell our listeners a little more about is, of course, the deductible of that homeowner's insurance. And maybe you have a thing that happens that is, sort of just above or right at your deductible. It's like, why even get into the insurance side of things at that point? It's probably the amount that you want to self-insure, right?
Yeah. Or self-fund, I like to say.
There you go. Yeah.
But there's a certain kind of, I call it a line in the sand where, okay, if something happens to my house, I'm going to foot the bill for this amount. But when it really starts to get closer to this, that's when I wouldn't want to pay more than that myself out of pocket. I wouldn't want to self-fund that portion of repairing or replacing my home. But if it goes above that, that's when I'd start to think about filing a claim, knowing that once I file a claim, it's going to be on my insurance record. My insurance is likely to go up after that. So I'm going to be paying more in my regular premiums.
And I can't think of a scenario where somebody's EFOF would be less than, right, their deductible, or should be less than their deductible, right? Your EFOF is almost going to always be well in excess of the deductible you would have to pay if you had a total loss, for example, on your homeowner's policy.
Yeah.
And that's important because that means you have self-funded those first dollars. It's there. It's built into your plan. It's what the EFOF is for. That's the emergency. And so, yeah, so it's part and parcel too, right? Having that EFOF in place is part and parcel to a good property and casualty insurance plan.
Yeah. And for any new listeners out there, the EFOF is the Emergency and Future Opportunities Fund, basically your rainy day fund. So something happens, you need to be able to foot this portion of your insurance bill that you have set for yourself. And you're going to want to make sure it's in your EFOF readily available so that if something happens, you've got it covered. And it's also true for folks who carry collision and other than collision coverage on their autos.
Like what's other than, like comprehensive, right? Is the other more traditional or other traditional sort of property coverage on your own property, right?
Yeah. And that covers stuff like, hey, a tree limb falls on your car and damages or totals it.
This tree, you need to get a new tree, it sounds like. The trees need
to be trimmed. We gotta maintain the trees.
Yes. I remember having old trees and they do need to be trimmed.
Yes. So homeowners out there can maybe avoid a claim on your homeowner's insurance if you take care of your property. Anyway, back to the auto piece, that collision and comprehensive or other than collision coverage. Most people are familiar with this if they have a new car or maybe a pretty pricey car that they wouldn't want to have to replace themselves if it was damaged or destroyed. So you get these coverages, you set the amount that you are willing to pay as your deductible. And I've seen deductibles as low as $100 on auto policies. Like people only willing to foot that first $100 if they had to make a claim.
And if your EFOF isn't prepared to foot more than the $100, like that's the thing we need to address first, right?
Yeah.
So it's $500, $1,000, like all of those things should be easy, right? The only limitation I can think of in a scenario like this is if you finance your vehicle or if you're leasing it. that financing and that bank or the lessor is going to require a certain deductible. Typically, they're going to say like you have to have no more than $1,000 deductible.
Yep.
Otherwise, it's to your advantage in a lot of cases if you have this type of coverage to maximize that deductible, especially if you are preparing well with a nice fully funded EFOF.
Yeah, because it's a trade-off. If you have really low deductibles, you're probably going to pay a higher premium every month or every 6 months or every year, no matter what type of policy you're talking about. This is even true for health insurance.
Right. And that's important simply because like all of these dollars, whether it's like what's paying for the deductible or what's paying for the repair or what's paying for the insurance, like, similar to how you mentioned with health insurance, like that total cost, right? That out-of-pocket expense is sort of on this, like, I guess, teeter-totter in a sense of like, as that deductible goes higher, that premium cost is going to go lower and vice versa. And it's really just sort of where you want to bear the risk, right?
Yeah.
Of this. Do you want to bear it out front and just sort of pay out some higher premiums so you have a lower deductible, or do you want to go with the odds, so to speak, and raise that deductible to where you could easily afford it with your EFOF, but it's going to keep your premiums reasonable.
Yeah, and you can kind of tailor and tweak all the different areas of your insurance. Some people don't realize this. They buy the insurance policy. They say, here, this is what the insurance agent provided me with. This is what I've got. And then I go in, analyze that, review it, kind of right size and tailor it to fit their lives based on, how much is in their EFOF, how much property they have to protect, other coverages that they might need that they didn't even know about.
And so what do you think some of the most common, like you went to your insurance agent and so they said, here you go. Here is your insurance policy. This is the amount of insurance you have. Like, what are some common things that you see that are, maybe could use some fine tuning in a lot of cases?
Yeah, when I'm reviewing policies, sometimes I get a little freaked out when I see coverage. So maybe we're building an initial financial plan and we're planning to give recommendations down the line once they schedule a strategy consultation to go over the strategy that we develop for them. Sometimes I get a red flag and I'm like, hey, we usually hold off and provide everything at once, but you really need to get this extra insurance. Some big ones are not enough umbrella coverage.
Okay.
If you've got $3 million in your taxable investment account, but you don't have any umbrella insurance coverage, that $3 million could be at risk if someone was to bring a lawsuit against you. So getting that umbrella coverage to protect your investments is huge.
Yeah. Your assets and your unprotected assets. I think I mentioned a little earlier in the episode about the idea that, there is some assets, maybe we haven't talked about this, some assets that are covered sort of by the laws of your state, right? And like Colorado, we have a certain amount of home equity. We have your IRA accounts, like that sort of thing. It just sort of depends state to state. But those assets are then protected in this scenario. It's really the unprotected assets that you're thinking about for that umbrella policy.
Yeah, and if you have questions about this or concerns about any of your own assets that may be unprotected, talk to a legal professional, not just your insurance agent or financial planner. Right. Your lawyer, your attorney is always going to be the best to answer those questions to, again, help make sure that you're protected. But another big one that I see that causes me to freak out a little bit is not enough liability coverage on your auto. And this is another state-by-state item. Every state has a minimum amount of liability coverage that you have to have on your car. Yeah. In our state, it's $25,000 per person, $50,000 per accident.
Yeah, that might not even cover the cost of a car.
No.
In certain accidents, right?
And it definitely wouldn't cover the cost of health care.
The medical bills
for many
and all
accidents.
The things. Yeah. No, that's a big one. I could imagine. What about that thing that's on in our state where there is fault declared, or I know in some of the no fault states this probably doesn't apply, but that on or underinsured motorist coverage, right? That's essentially you're buying insurance for that other person, right?
Yeah. And I have some personal experience with this. I was in an accident caused by an uninsured driver, and they were fully at fault. And they had no insurance, so I had to rely on my uninsured, underinsured coverage to claw some dollars back after that accident for myself.
Yeah, interesting. And that's, I think, Like a lot of that, I know I've thought about this type of coverage in the past, and my thinking has evolved as far as like what it could be useful for and why it would apply and what sort of scenarios you want to consider. But I mean, I think it's important also to keep in mind that it is insurance for someone else, and it's you that is essentially the beneficiary of that specific insurance. And so what do you need in a scenario where you were involved in an accident? Do you need your medical bills paid? Do you need something down towards that next car, whatever the case is? Do you have comp and collision, as an example, that could cover some of the damage to the vehicle itself, right? There's all these little factors that I'm sure go into this decision.
And if you want to dig deeper, if you don't have collision coverage, you could rely on something called uninsured motorist property damage coverage.
Mm-hmm. So like the equivalent of collision for an uninsured motorist, essentially?
Yeah. So
interesting.
Check your policy. You might want to add that on if you don't carry collision coverage. But I think the last big red flag item that I see every once in a while has to do with not enough dwelling coverage on a homeowner's policy.
Mm-hmm.
Because if you don't have enough dwelling coverage and something happens, you need to make a claim, not only are you out of pocket for the deductible that you're going to rely on your EFOF for, but you're also going to have to pay a prorated amount of the repair because you didn't have enough coverage on your home.
Right. So the total cost of the, bill to fix everything, let's say they're going to rebuild your home, it's $500,000 and your dwelling coverage was capped out at 80% of that, $400,000. You may be on the hook for that additional $100,000, or perhaps your policy, and I know I've seen this on my policy, has for a total loss scenario has an extension of those benefits to get you to that higher benefit amount if you need to replace the whole home.
It's basically like the insurance company saying, hey, you didn't pay us enough throughout all these years of your policy, or at least during the policy that you're on at the time the damage happened. You haven't been paying us for enough coverage, and now you get to pay a little bit more for what just happened.
Right. Fascinating. One I could also think of, I guess, that is, I've been guilty of, and I have to watch myself on, is that comp and collision coverage, carrying it on older vehicles, where it's like you're almost at the point where the deductible is a meaningful, a material percentage of the actual value of the vehicle. And so it starts to become like, why are you paying for that premium at all? And so really, especially if you have comp and collision on, vehicles over 5 years old, like start to really look at, like, that's where you got to start to look at the numbers, right? You got to make sure that that's still worth it. I mean, if you have a certain vehicle that just carries its value really well, like, full-size pickup trucks tend to do that, right? Mm-hmm. Like maybe you carry that coverage a little longer, but others that aren't quite in the same boat, like you probably don't need it when you get into that second half of the first decade of the ownership of your vehicle.
Yeah, definitely when you start to hit that 10-year mark is when it's time to see how much your vehicle actually might be worth and see whether it makes sense to drop the comp and collision coverage. Make sure that you have the underinsured or uninsured property damage coverage and the liability coverage on the uninsured portion. And maybe see if it might make sense to pocket the money that you're paying for the comprehensive and collision coverage. Save that towards your next vehicle.
Well, I think that's a good chance to get into today's takeaway. And takeaway number one for me is, of course, property and casualty insurance itself is what covers your stuff, your personal and real estate property, as well as your liability to others if you cause something to happen that would cause them financial loss.
Takeaway number two, the types of insurance that fall under the property and casualty umbrella include not only home or renters and auto insurance, but also umbrella.
Umbrella insurance under the property and casualty umbrella. And takeaway number three, as you own these policies, consider the interaction between things like your deductible, right, and your premium cost, your coverage for both the property and your liability in some scenarios, and make sure that you are evaluating these factors relatively frequently so that you can make sure you're optimizing that insurance coverage.
Love it. Well, what did we miss today? Or maybe you want to share a favorite factor of your own insurance with us, property and casualty in particular. Reach out to podcast@fpfoco.com or go ahead and give us a follow on your favorite social media channel.
Well, that's fantastic. Thanks for listening, and we'll talk to you soon.
Jason Speciner and Regina Neenan are investment advisor representatives of FP FOCO, a registered investment advisor. The information in this podcast is provided for general educational and entertainment purposes only. It may not apply to you or your specific circumstances and should not be considered financial, investment, or tax advice.